Welcome to the Deep Dive. Today, we're jumping straight into the first quarter 2025 earnings call for Washington Trust Bank. That's ticker WRSH.
Yeah, and the overall vibe from the call seemed pretty positive. They're definitely seeing some good results from that balance sheet restructuring they did late last year.
Okay, so let's start with the highlights. What did the bottom line look like?
Well, they reported net income of $12.2 million. That works out to $0.63 per share.
And was that a clean number, or were there some adjustments?
Good question. There were a couple of infrequent items in there. If you pull those out, the adjusted net income was $11.8 million, or $0.61 per share.
Got it. What about interest income? That's always key for a bank.
Right. Net interest income actually climbed quite a bit. It came in at $36.4 million, which is up 11% from the last quarter.
11% quarter over quarter. That's pretty significant. What drove that?
A big part of it was the net interest margin, or an IM. It expanded quite nicely to 2.29%.
Wow. Okay. How much of an increase was that?
That was a 34 basis point jump from Q4. So yeah, definitely a noticeable improvement there, likely thanks to that restructuring.
And on the other side of the balance sheet deposits, how are they doing attracting funds?
Seems like they're doing well. They actually hit a record high for their in-market deposits.
A record? What was the number?
$5.13 billion. So that suggests their local franchise is pretty strong.
Okay, record deposits. What about loans? Did they see growth there too?
Actually, no. The loan portfolio dipped slightly, down about 1%.
Oh, okay. Any cause for concern there?
Management didn't seem too worried. They said it was partly intentional. They cut back on some residential mortgages. Plus, they had some higher than expected payoffs in commercial real estate, CRE, and businesses weren't drawing down their credit lines as much.
Ah, so a mix of factors, not necessarily weak demand.
Exactly. And they did say their pipelines for new loans are building up again. They're guiding for low single-digit loan growth going forward.
Okay, that makes sense. What about their other business lines like wealth management?
Wealth management brought in $9.9 million in revenue. That was actually down slightly, about 2%.
Yeah, in mortgages. That's been a tough market.
Yeah, mortgage banking revenues reflected that. They were $2.3 million, down 19% from the prior quarter.
Ouch.
But here's the interesting flip side. Their pipeline for future mortgages surged. It was up 59% by the end of March, hitting $95 million.
So maybe some pain now, but potential for a rebound later this year if those close?
That seems to be the idea. Something to watch, for sure.
All right, that's a good snapshot. Let's dig a bit deeper now. You mentioned that Q4 balance sheet restructuring a few times.
Yeah.
It sounds like it was a big deal.
Oh, absolutely. They kept pointing back to it on the call. We already talked about the NIM improvement.
Right, the 34 basis points.
Yeah, but it also helped their loan-to-deposit ratio, which is now sitting at 100.7%. Pretty balanced.
Which is generally seen as a healthy spot, right? Not lending out way more than you have in deposits.
Exactly. And critically, it boosted their dividend coverage and their capital ratios.
Let's talk about those capital ratios. Why are they important for listeners to understand?
Well, think of them as the bank's safety cushion. Ratios like the CET1, which improved to 11.76%, and total risk-based capital, now 13.13%, measure how much capital the bank has relative to its risky assets.
So higher ratios mean a stronger buffer against unexpected losses.
Precisely. It shows regulators and investors the bank is financially sound and can handle potential bumps in the road. These improvements suggest a more solid footing for Washington Trust.
And the deposit growth hitting that record level, how did they pull that off?
It seems like a combination of things. They mentioned growth in new households, which is always good to see. And their strategy involves both traditional branches and these retail sales officers who are out actively looking for both loan and deposit business.
So boots on the ground trying to bring in new business.
It seems like it's working. Competition for deposits is still fierce, they said, but they're managing to grow.
Now, you mentioned some infrequent transactions impacted the reported net income. Can we break those down?
Sure. There were two main ones. First, a gain. They sold 5 branch locations and then leased them back. That resulted in a pre-tax net gain of about $0.7 million.
Okay, freeing up some capital tied up in real estate. What was the second item?
The second was a charge. They terminated their qualified pension plan, which resulted in a one-time non-cash pre-tax charge of $6.4 million. It's basically settling that future obligation.
Got it. So one gain, one charge, netting out to an impact on the reported numbers. What about ongoing expenses? Did they keep costs in check?
Adjusted non-interest expenses did tick up a bit, by 4% to $35.8 million.
Any particular reason for the increase?
They largely chalked it up to higher payroll taxes, which is pretty common at the beginning of the year. They didn't change their overall outlook, expecting the full year effective tax rate to be around 22.4%. Seems manageable.
Looking ahead, everyone wants to know about interest rates and the Fed. What did management say about the net interest margin outlook for Q2?
They were cautious, of course, acknowledging the uncertainty, but they did give guidance for Q2, expecting the NIM to nudge up slightly higher, maybe around 2.35%.
Okay. Continued modest improvement expected there. Let's talk dividends. Always important for bank investors. Any change?
No change to the dividend itself. It's still 66 cents per share. But they were quite clear about their focus here.
Which is?
Lowering the payout ratio. They want to get that ratio, the percentage of earnings paid out as dividends, down over time, primarily by growing their net income.
So don't expect dividend increases anytime soon.
Explicitly no. They said no plans for near-term increases. They're targeting a payout ratio in the mid to low 80s by the end of this year.
Interesting. A high payout ratio can sometimes constrain growth, right?
Yeah.
Leaves less money for reinvestment.
Exactly. Getting it lower gives them more financial flexibility down the road, whether for organic growth, maybe acquisitions, or just building capital.
And given all the changes, especially the restructuring, has their sensitivity to interest rate changes shifted?
Yes, that's a key point they made. They've moved from being what we call asset sensitive, meaning rising rates would really help their margin, to a more rate neutral position.
Meaning future rate cuts, if they happen, might not boost their NIM as much as they might have previously.
Correct. It makes them less dependent on the direction of rates, aiming for more stability either way.
Back to deposits for a second. They mentioned one large relationship contributed to the growth. Is that a concentration risk?
They did flag that one large relationship helped, but they were quick to add that the growth was also broad-based. They saw organic growth, plus results from those retail sales officers and specific deposit promotions.
So not all eggs in one basket, but still something to note.
Right. And they did reiterate that competition for deposits is intense out there.
Let's shift to credit quality. How are their loans performing? Any signs of stress?
Overall, the metrics look pretty solid. Non-performing loans were low, just 0.42% of total loans.
And past due loans?
Even lower, it's 0.20%. Their allowance for potential future losses, the ACL, is $41.1 million.
How does that stack up against the non-performing loans?
It covers them quite well, about 190% coverage, so a decent cushion there. Net charge-offs in Q1 were $2.3 million, relatively contained.
Okay, now for the area everyone's watching closely, commercial real estate, or CRE. Any specific issues highlighted in their portfolio?
Yes, they gave some useful color on a few situations, especially within their non-accrual loans.
Like what?
Well, there's one relationship involving 2 loans secured by 3 office buildings. They actually took a charge-off on one of those loans recently because of a lower appraisal.
That doesn't sound great.
But there's a positive development, too. One of those 3 buildings is apparently under a purchase and sale agreement expected to close this quarter, Q2. If that happens, it should reduce their non-accrual loans by around $3.3 million. So, progress there potentially.
Okay, any other notable CRE situations? There was a lab property mentioned.
Yes, a $20.5 million loan on a lab property. It's currently just over half leased up.
Still quite a bit vacant.
True, but they also said there are active lease proposals out, which is encouraging. And the borrower seems committed. They've apparently invested quite a bit more recently in building out spec suites to attract tenants.
And the loan itself.
They extended the maturity out to sometime in 2026. So it seems like they're working with the borrower, giving the project more time.
What about that Class B office property? The one where the recent charge-off occurred?
Right. That specific loan was tied to a Class B office building that's 50% vacant. Crucially, though, they noted the loan is still performing. The borrower is making payments.
So the charge-off was more about adjusting the carrying value based on the vacancy and market, not necessarily a default?
That seems to be the implication, yes. A more conservative valuation reflecting the current reality for that type of property.
Okay, one last area before we wrap up the details. Share buybacks. Did they mention anything about repurchasing stock?
They did address it. They don't have an active buyback program authorized right now.
Yeah.
But the board is considering it. They see it as a potential way to use capital, especially mentioning the current stock price relative to where it's been historically.
So it's on the table as a possibility for the future, just no green light yet.
Exactly. Something shareholders might keep an ear out for down the line.
All right, let's try to pull this all together. For someone tracking Washington Trust, what are the main takeaways from this call?
Well, first, that Q4 restructuring seems to be genuinely bearing fruit. You see it in the improved NI, the better capital ratios. It suggests a more stable financial base now.
Yeah, the foundation looks stronger.
Second, the focus on deposit gathering and the building loan pipeline points towards potential future growth. It might be slow, maybe low single digits like they guided for loans, but the trend seems positive.
And third, that CRE exposure needs watching, but they gave helpful details.
Absolutely. You got some clarity on these specific non-performing assets, like the office buildings and the lab property. Monitoring how those situations resolve and the leasing on that lab space will be key. It gives you a sense of the risks, but also how they're managing them.
And the dividend discussion really highlighted their priorities.
Right. It's about strengthening the bank's earnings power to lower the payout ratio naturally, rather than just hiking the dividend now. It signals a focus on long-term stability and maybe preserving capital for growth or, as they mentioned, potential future buybacks.
Okay, time for our favorite segment. It's the "this is not financial advice" part of the deep dive, where we toss around a slightly wild but maybe plausible trade idea based on everything we've just discussed.
All right, let's brainstorm. Given Wash's proactive moves and relative stability compared to some peers, how about this? A pairs trade.
Okay, I'm listening. Long, wash, and short.
In short, another regional bank, specifically one that has a much heavier concentration in, say, Class B office properties, particularly in markets seeing rents fall and vacancies climb. And crucially, a bank that hasn't done the kind of balance sheet cleanup that Washington Trust undertook.
Interesting. So betting on the divergence between a bank that took its medicine early versus one that might still have some pain ahead in that specific CRE segment.
Exactly. The rationale is Wash H seems relatively better positioned now, having addressed some issues via the restructuring and having improved its capital. You'd be betting that this relative strength will play out compared to a peer facing potentially more acute unaddressed risks in those challenged office assets.
It hinges on finding that right counterparty for the short side, obviously. One with that specific vulnerability and lack of proactive measures.
Precisely. It's a relative value play within the regional bank space, focusing on management strategy and portfolio specifics. But again, we have to stress it's just a hypothetical thought experiment.
Absolutely. Not financial advice. Do your own extensive research before even thinking about making any trade.
Definitely.
Well, that wraps up our deep dive into Washington Trust Bank's Q1 2025 earnings call. We've hit the key numbers, management's commentary, the drivers, the risks, and even a wild trade idea.
Hopefully this gives you a clearer picture of the bank's current situation and what they're signaling for the future.
But remember, this is just our take based on the call. There's always more digging to do. Think about what stood out most to you, what questions remain.
Yeah, keep asking questions, keep digging into the details yourself.
Thanks for tuning in to the deep dive. Join us next time as we dissect another important piece of market news.